Oil up, rates up, housing prices up. Is this all a setup to the next recession? Stay tuned, we'll discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget you can click Show More for additional information, links to articles, and charts from today's video. First up, we have a question from one of our viewers. Should we be worried about a recession?
That is an excellent question.
Well, let's talk about that a little bit, dig a little bit deeper. First up, we can only use the past as a guide to hopefully help us as we look towards the future. A lot of words there to say, let's take a look. First up, if we go back to 1950, we've had 13 times where the Fed has been raising interest rates. 10 out of 13 of those times has gone into a recession. Next, here's a chart I created this weekend after I got our question here. And we go back to somewhat the modern era, but you can see a couple things. At the bottom are oil prices. You have the S&P, Fed funds rate, and then also the 10-year Treasury. And as you see, each time we've had rising interest rates, rising oil, the red line is a recession. So I have on the end there, we're seeing all those right now. That, of course, is a big question mark. Now, next, going back to more data, every decade has had some type of recession going way back to the 1800s. This so far is the first decade where we have not had any type of recession here. So the 2010s, at this point, nothing. So very interesting to see that. And last up, predictions from Wall Street. Everybody has predictions, not me, but it shows you, yeah, a small percentage see it coming in 19. Majority of analysts say 2020. I'm more in the 19 mode, but we will see. Let's get to the numbers. Week ending 5/18. Across the board, mixed, very mixed. NASDAQ down, Dow down, S&P down. Mids and smalls up. Smalls, big. We're going to talk about that a little bit more. And then the S&P, as weak as the S&P has been this year, 1.47, 64% of that return is coming from the FANGs. Not a good thing, not a lot of breath. Let's go to the big charts. Okay, so this week I'm simplifying it. I had way too much on that daily chart last week because there is a lot going on. So what did we see last week? A pause again. So here I've drawn a box about where we've been and kind of stuck in this box here. So that box represents about 7.5%. And where we closed on Friday, we're about 5.7 from our all-time highs. Now the only good thing that I see here is at the bottom, nice little bullish flag there. You can kind of see it setting itself up, and with tariff talks off the table for now, futures look to be pretty good. So we are still positive on our short-term view. Next up, midterm. Yeah, we still have that bullish uptrend, but a lot of turnovers there in the bottom, negative turnovers that bring us a little bit of caution. So midterm are still negative, and then long-term, as you would expect, bullish trend line still very much intact. So yes, our long-term signals continue to be positive. So short-term positive, mid-term negative, long-term positive, give us more of a neutral view, which kind of explains why we're in this box. Next up, NASDAQ. Just want to give you a quick update. Not the bullish flag forming here, kind of bouncing around. Let's see if we can move ourselves up. Not a good week last week, but as tech goes, surely the market goes. Market breadth, not going to get into that, just to say that, yeah, it's pretty strong. You know, 60% or above is good, and that's what we're looking at. Next up, sectors. But before we go there, don't forget we have the Wealth and Wisdom Financial Plan. For those viewers, we have a link below. Check it out today. So sectors here, this shows 76% of the overall S&P. And again, not a lot of good breath going on here. Financials up last week, health up, consumer discretion down, and industrials up. So pretty much a mixed view across the board. Now, U.S. equities, 10 of 11 in an uptrend. That is up from 8 last week. International, 22 of 53. That's also up from 8 last week. So a little bit better. So equities in an uptrend. International still in a downtrend. Next up, tweets of the week. So first up, we have Scott Minerd from Guggenheim. Really great follow. Rising rates are at the heart of the market shakeup. In the first quarter, we observed the cost of borrowing money was going up and going up faster than the Federal Reserve had planned. At some point, it's going to bite. Yes, indeed. Stay tuned. We'll get some more there. Next up, Jesse Colombo. As a reminder, the commercial hedgers, smart money, are short oil now. The most they've been short since 2014. Very interesting to see. As he calls dumb money, everyone's rushing in to get in, but the smart money is not. Last up, David Rosenberg, another great follow. With Japan's GDP contracting in Q1, Eurozone pace sliced in half, one can safely bid au revoir, right, to the synchronized global growth story. Indeed, we see that with our international picture. Next up, let's talk about treasuries. Treasury spreads up a little bit last week, 0.44 to 0.51, still very low. Rates continue to surge up. Next, we have a new chart here. I added this weekend. 3-month, 6-month, 1-year, 2-year, and 10-year, all at the highest level since 2008. Borrowing costs go up. Spreads, treasury yields across the board continue to go up, and that is a concern. On my radar. So this week we're going to talk about banks. We saw they had a decent move last week. So here we see a couple things. First, the overall picture. Do we like it, not like it? I think a couple things. You kind of see that we bounced off the 200-day moving average. Good sign. Went above the 50, and then we turned down at the end of the week, probably because rates came down a little bit. And when you look at relative strength on the top end, at 50, momentum, MACD at the bottom, okay. Do see a button hook to the downside. So I look at it, I'm not rushing in today, that's for sure. So let's go a little bit deeper here. When I make a decision, it's not just looking at that particular chart. Here again is the banks in a closer view. Then I have banks relative to the S&P in green. So relative performance. Who's performing better? You can see how they did in fact perform better and then kind of have gone down a little bit. So not strength. If I'm going to add alpha, alpha being performance, to the portfolio, I don't see it yet. And then at the bottom there, banks correlated to the 10-year treasury. As the treasuries goes, banks go. So if rates go up, banks will go up. And you see the correlation is very high. So again, right now, kind of a mixed view. Going to hold off for now. The next one, a new chart, the insurance business. Very interesting here. Kind of a similar setup. We broke out, consolidated. But what I'm looking at here is one, in the middle there is volume. Lots of volume here in the last couple months. But at the bottom is correlation. So this is very interesting here to see correlation to the 10-year negatively correlated, which as you see is very unusual. So I'm watching this. Maybe we make a turn and the insurance space might be a good opportunity. Next up, what keeps me up at night? Yes, we have not learned from our past transgressions. Here is the housing ATM is back. Have an article below on this. People again are borrowing from their equity. not a good sign. Next up, a warning signal for global stock markets is flashing in Japan. Heard David Rosenberg talk about that. Right now, defensive, this shows you defensive, okay, versus cyclicals, and that's outperforming. That's not a good sign. Last but not least, the Pope. Yes, that Pope calls the derivatives market a ticking time bomb, and if the Pope's getting involved with this, you got to pay attention, right? Wrapping things up, fear and greed this week. We're pretty neutral, like we talked about in our signals. Right there in the 50s, not much of a change. Again, indicators, short-term positive, mid-term negative, long-term positive. As always, thanks so much for watching. This is Michael Loftus for Wealth and Wisdom TV.